Hey there, welcome to the channel. So today was Fed Day, 50 bips increase, and the market seemed to love it. All right, so if we look what happened today, so the Federal Reserve came out and made their interest rate announcement, and they raised it by 0.5%, 50 basis points. So now that puts the Fed funds rate at somewhere between like 0.75% and 1%, kind of puts it in that range. So we're on the door of 1% here. Now, the market, for whatever reason, has just loved this today. This is a huge bar. Looking at the NASDAQ, went up 2.8% today. It's like pretty much, yeah, amazing. The market really loved it. It was, if we look what was happening yesterday, they had this move and they really cranked it up, and then it was just kind of flat, and then the Fed announcement came out, and then as he started talking, it was really interesting because he talks about how, like, well, I expect to, the next several meetings to have to do 50 basis point increases, and for some reason the market really loved that, which is kind of surprising. So let's see what happened with the SPY today. I mean, a big move as well, up 3%. IWM up 2.6, not as much. Our 10-year yield went down today, but still hovering around 3% there. And then we can look at our oil. I want to look at that really quick. Yeah, if you look at your Brent here, look how it started popping out. So basically we have the EU is mostly planning on banning Russian oil, except there is one country, Hungary, or another country that's actually not agreeing to that right now. So we'll have to see what happens with that. I mean, if they don't ban it, then I would expect oil to dump a little bit. But for right now, yeah, I don't know what they're going to do. I don't know if they all have to unanimously agree, or can some of the countries kind of back out? Can the other country agree and then just kind of ignore it and keep importing the oil anyways? I do not know. So definitely for today, we have this going out to the weekly chart. I mean, it's kind of so far it's like a bullish engulfing for the week, and there's quite a few more days of the week left to go. So we'll see what happens, but it sort of does have that look like, it kind of hammered out a low today. So, but the bigger picture, so like the bullish case, could be, it's really, look how that is flat. The 50 is flat. And the 200 is, well, I'm sorry, this is the 50 week in red. So this guy's like the 200 day, and the 10 is like the equivalent to the, like the 50-day moving average. So they really had crossed over really hard. They're really putting in a lot of space between them. And really the longer term average is flattening out. So we'll have to see what happens this week. I mean, the bullish case would be, we can start working our way back up. And then the question is, are we going to break this point in the 380? If that was to happen, you would see that this could be a really big correction. This correction would take a half a year or more to play out. And if it was to come back up and start going up, you could restore your uptrend on that long-term, weekly chart kind of basis. The other thing is, we could get some kind of a bounce here. We could even get all the way up to the old highs, and, maybe we fail and we break down and go lower. Obviously, there's infinite things can happen, but from this point of view, I'm not really overly optimistic at this point. So looking at why the market was really happy about this move today, I guess it's I mean, it makes no sense to me, right? I guess the market had talked itself up into a fury over the fact that maybe they were going to do 75 basis point rate increases or something. And hence, when the Fed was talking only about doing 50 basis points, that made them happy. But I was watching it on the Meet Kevin live stream, and I believe he was talking about 50 basis point increases for the next several meetings. Now, you can correct me if I'm wrong, but the next several meetings, I mean, that is a very fast move in interest rates. You're talking in a very short period of time of only 3 months, you're going to go from essentially 25 basis point to 1.5 basis point, or maybe if he does the next two meetings, that'll increase another. You'll be really close to 2% very soon. And that is very fast. So I don't know why the market was happy about that. Now, that said, I don't know that the market was really happy about it. I mean, obviously we had a huge up day, but it very well could be more likely that there was a lot of short interest out there somehow. You know, there's a lot of people short. They were looking for it to be maybe the market response to be like a bloodbath or whatever, and that didn't happen. And so basically those people who were short, you know, had to run in and cover, and there you go. There you get your rally. So from my perspective, I mean, I don't think this is the low. I mean, you know, as long as the Fed is still doing what they're doing, and you know, they are continuing. I mean, they are just being very frank about it. And I think it's also telling that Powell's initial, when he opened up the press conference, he spent a few minutes talking directly to the American people, talking about how, hey, I understand how inflation is hurting the average person, yada, yada, yada. And they really talked about that. And then he even got a question about, why did you make that statement? You know, why are you talking to people, et cetera, about inflation? And so I found that interesting. Now, I don't know that I've ever seen that before. I'm not saying I'm a big Fed watcher, but I think that was kind of unique for a Fed president to just go and directly talk to the American public. And this must mean, I mean, let's try to figure this out. This must mean that he's very aware and getting kind of pressure about this inflation, right? And therefore, just listening to that opening statement, it would seem to me pretty clear that he's dead set on like killing off this inflation. So I don't know why that would be like a positive for the stock market. The answer is it really, really wouldn't, because if he's going to increase by 50 basis points for the next few meetings, that's a lot. You know, we had this talk about, if we look at how much they raised rates in the 80s when Volcker came in the late 70s and 80s, and he basically, you know, killed off inflation, the high inflation we had in the 70s and 80s, by increasing interest rates a lot. And so the basic idea is what he did was gave us actual positive real rates. Like, for example, right now, our real rates are very, very negative. Our inflation is 7-8%, depending how you measure it. The yields on the 10-year are 3%. So you're at minus 5%. So we're very negative real rates. And therefore, the thought is that that is very, very inflationary. So for him to get that off, to kill the inflation, he's got to get those rates high. So as it would stand, you would look at it and say, well, oh, he needs to raise interest rates from, he needs to get, for example, the 10-year, he has to raise the Fed funds rate to wherever it is that will get him like the 10-year to a positive yield, which would be at this point something like 7%. And that would be very high. Now, I think I'm in the camp with like the George Gammon and other people that are like, look, there's no way they can raise rates that high. I mean, there's just too much debt in the economy across the board. You have debt at the consumer level, you have debt at the federal level, state level, all these different levels. Like, just no one can handle that increase, handle their payments with increased interest rates like that. So it's a kind of interesting thing. It's very clear to me that it's like, when you look at the charts and you look at all these charts, yeah, when you look at a long-term chart, and I'm looking at the Fed funds rate here. So what's going on with this chart is that this goes back to 1980 and 81. And you see the Fed funds rate was very high. Fed fund rate is on the left. So this is literally 19%. These spikes in the Fed rate are up to 19%. But as you can see, these, when you look at it, as anytime the Fed goes on a rate rising cycle, like in this case, in the first half of the 90s, they raised and they got away with it in terms of the stock market. Then we had the problem in 98, long-term capital management. They cut rates. That's all fine. But then they started raising rates again into 2000, and then they held, but it kind of broke. Everything broke. And you can see that, okay, what's the correlation, which is not necessarily causal, but it's it's a correlation that you see very often. You know, they raise rates, they go on a rate raising cycle, and when they go on a very concentrated rate raising cycle, the market, and often you'll see as well, you will see that will go into recession. So basically, they caused the recession here in 2000, bring off the rates, market starts recovering later and starts going up. Then they crank the rates up. And about a year and a half later, then they hold them. But a year and a half later, we get the financial crisis, and that goes to heck in handbasket. They go to zero in 2009 for incredibly long time. And then it's interesting, even just this little tiny talk of interest rates, the market kind of held off a little bit here. But then they go on a rate raising cycle and they come into here and they cause the temper tantrum over here. And then they've kept it up there all the way until what happened here. This was the cerveza sickness. And then they brought it back to zero. So what you see when you kind of look through all these charts and you try to see if there's a correlation between the Federal Reserve raising rates and either a recession or the market correcting, very often it's often just not possible that they can get it right. So, and especially when you look at it and the speed of the rate increases and the consistency of them, that is like a very big determining factor. You know, it's one thing if it was like every other month they were raising rates 25 basis points. Another thing when you just raise it 25, you're raising it 50. If you raise it 50 two more times in a row, every 6 weeks you're raising 50 basis points. You go from, you know, interest rates at that low level being 0 to 2%, forcing up your mortgage rates to like 5-6%. You do it that quick, it just hits the economy very fast. Economy that's used to low interest rates cannot handle that quick increase. They just can't handle it. They break something. So therefore, you know, I'm definitely in the camp where the Fed is not going to get that far. And it's not a positive thing because they're going to go and they're going to break something. And when they break something, yes, they're going to come back in and have to cut rates. I don't know how exactly they're going to sell it because if there's still high inflation and they've broken something, the cutting the rates is going to maybe look bad. However, they'll probably get away with it from the perspective that when they break something, the economy will look really bad and we'll probably get a, you know, deflationary downburst, right? Because the demand, it will like, you know, basically whatever part of the economy is going to get hit, and probably housing is going to take a big ding. Very speculative parts of the economy are going to take a ding. And when that happens, it's going to happen really fast. The Fed will have broke something and the Fed will come back and cut rates, even if inflation is still high, because what they will assume is that the inflation is going to drop off because the demand will drop off. And I would think there's some reasonable chance to that, right? Because like, hey, if a bunch of people start losing their jobs, et cetera. I mean, right now in housing, there's just layoffs after layoff in, you know, the mortgage finance industry, because it just, you know, who the heck is going to go ahead and refi right now? It just makes no sense. So it's that volume in the refis has dropped off, and that's how, you know, a lot of people made a living. So that's a tough one for them. So I think that's it for this one. I'm not buying this market move at this point. I think we got more pain to come. All right, bye.